They didn't call it a bailout. They called it stabilization. But what Argentina signed was something far darker. In March 2023, amid a collapsing peso and skyrocketing inflation, the IMF returned once again, offering billions of dollars in exchange for promises. Promises to cut pensions, slash subsidies, freeze wages, sell assets. For the 34th time in its history, Argentina bowed to the same savior that broke it. And this time, the chains came dressed in suits and spreadsheets. This isn't just another loan. It's a blueprint of control, a quiet colonization disguised as financial rescue. Across Latin America, the pattern repeats. Debt becomes the leash, and every nation that bites the hook is dragged into the same spiral. Crisis, agreement, surrender. And no one dares to call it what it is, selling sovereignty for survival. But that's exactly what's happening. And Argentina is just the latest sacrifice. Argentina's relationship with debt is not just economic, it's existential. In 2023, as the peso collapsed and inflation devoured savings at over 100% annually, the government turned once more to the International Monetary Fund. It was the 22nd IMF arrangement since 1958, and by far the most desperate. The country owed over $44 billion to the IMF alone, and the New Deal added layers of austerity in exchange for short-term liquidity. The script was familiar. Cut public spending. Raise interest rates. Devalue the currency. The prescriptions came with glossy charts and technical language, but the results on the street were brutal. Mass layoffs, food insecurity, black market dollar. This wasn't rescue. It was control through dependency. What makes this modern chapter different is the sheer predictability of the fall. Argentina had already lived through its lost decade in the 1980s, when debt restructuring crippled growth and handed key decisions over to Washington. In the early 2000s, the country declared the largest sovereign default in history, $100 billion, and swore never to repeat the mistake. But debt, like empire, evolves. This time, it returned not as brute force, but as elegant pressure, quiet, contractual, and lethal. Each disbursement became a countdown, each condition a noose. People took to the streets again, students, unions, pensioners, not against war or corruption, but against numbers on a document signed in a room they'd never see. That's the dark genius of sovereign debt. It removes accountability. It turns democracy into theater. Decisions made by foreign economists are rubber-stamped by elected officials who offer no real choice. The crisis becomes self-perpetuating. The rescue becomes the trap, and the nation's future is traded, piece by piece, for the illusion of survival. Argentina is not the first. It won't be the last. But it may be the clearest mirror yet of what it looks like when a nation sells its soul for debt. Sovereign debt was never just about money. It was always about power. In the 1980s, Latin America learned that lesson the hard way. One by one, countries across the continent, Argentina, Brazil, Mexico, Peru, fell into the same pit. Massive external borrowing in the 1970s, followed by a sharp interest rate hike from the United States. And suddenly their economies collapsed under the weight of unpayable debt. What followed was a decade lost not to war or natural disaster, but to financial restructuring. The IMF and World Bank swept in with rescue packages that came with strict conditionalities, a sanitized word for forced economic obedience. Public institutions were gutted. Utilities were privatized. Social programs were slashed. And in place of national policy came foreign consultants, spreadsheets, and the doctrine of fiscal responsibility. The promise was growth. What they got was stagnation. This cycle of dependency has become a feature, not a bug. The logic is deceptively simple. Lend heavily during global liquidity booms, then tighten monetary conditions in the developed world, triggering debt crises in the global south. And when those countries can't repay, institutions like the IMF offer rescue on their terms. It's a trap that looks like salvation. Argentina was the poster child of this system and remains its most tragic example. In 2001, after years of currency pegs, capital flight, and IMF-imposed austerity, the country imploded. Banks froze accounts. Unemployment soared. The middle class collapsed. Protesters chanted, "Out with them all!" and presidents resigned one after another. The nation defaulted on $100 billion in debt, the largest sovereign default in history. That should have been the end of it. But it wasn't. Debt does not die. It regenerates. By 2018, Argentina was once again drowning in obligations and reached out to the IMF for the largest bailout ever approved. $57 billion. The program failed spectacularly. Growth fell. Inflation soared. Poverty exploded. Yet when a new crisis struck in 2023, the IMF returned, not with a reckoning, but with another agreement. The deal was dressed in modern language: climate accountability, gender budgeting, digital infrastructure. But the core remained unchanged: cut spending, service the debt, and sell the future. Each agreement came with promises from Argentina's leaders, often under pressure, often with no better alternative. We had no choice. That phrase, "we had no choice," has become the most common refrain in countries under financial siege. But it masks the real story. That choice was removed long before the papers were signed. When a nation builds its economy on dollar-denominated debt, it surrenders its ability to devalue, to print, to breathe. It becomes hostage to foreign capital flows, interest rates set in Washington, and credit ratings from firms that don't speak the language of the people they judge. It's no longer just about money. It's about sovereignty. Argentina lost control not because of a single bad decision, but because it entered a system designed to extract, not empower. And every crisis becomes an opportunity for someone else. Debt has become the empire's most efficient weapon. Unlike tanks or warships, it doesn't provoke resistance. It invites compliance. It offers prestige, access, even stability, until the bill comes due. And when it does, the consequences are devastating and uneven. In 2023, Argentina was forced to raise interest rates above 100% to stabilize its currency. That destroyed small businesses, crushed consumer demand, and left ordinary people paying the price for elite decisions made decades earlier. Inflation ravaged pensions. Rent doubled. Medicine became unaffordable. And still the payments continued. Transfers from one of the world's most unequal countries to international creditors, facilitated by governments desperate for temporary relief. This isn't just an Argentinian story. It's a global pattern. Ghana defaulted in 2022 and was immediately steered into an IMF deal. Sri Lanka collapsed into political chaos under the weight of foreign loans. Pakistan faces rolling blackouts, soaring fuel prices, and external debt that dictates every budget decision. In each case, the story is the same: borrow during peace, surrender during crisis. The modern empire does not occupy with soldiers. It dictates with spreadsheets. And debt is its preferred language of conquest. But this system only works because it is invisible to most. Debt agreements are written in sterile terms: extended fund facility, standby arrangement, structural adjustment. They sound technical, boring, even helpful. But behind the jargon is pain, real generational pain. Hospitals that can't afford syringes, schools that shut down for lack of heating, farmers priced out of their own land. The documents are signed in air-conditioned rooms in Washington, but the consequences unfold in dusty towns, overcrowded clinics, and urban slums thousands of miles away. That's the power of debt. It allows control without presence, extraction without ownership, empire without a flag. For Argentina, the cycle has become so entrenched that it's hard to imagine an exit. Each new government blames the last. Each new loan pretends to be different. But the people know better. They've seen the promises fade, the currency evaporate, the future sold off in increments. Protests still erupt, but the fatigue is growing. Hope has turned to resignation. And that may be the cruelest victory of all for those who benefit from the cycle: a population too exhausted to fight back. The question now is not whether Argentina will default again. It's when. And who will be waiting with a rescue the moment it does. Because the game isn't designed for recovery. It's designed for repetition. And as long as the illusion of choice remains, the system continues unchallenged. That is the real cost of sovereign debt, not just the money repaid, but the autonomy lost, the dreams deferred, and the dignity eroded in the name of stability. In the end, sovereign debt is not just an economic instrument. It's a story that nations are forced to tell themselves over and over again. We had no choice. It's only temporary. This time will be different. But the numbers don't lie. The cycle doesn't change. And for countries like Argentina, the story is no longer about debt. It's about survival in a system that was never meant to let them win. The numbers don't just tell a story, they reveal the trap. In Argentina's 2023 IMF deal, the agreement required a primary fiscal surplus of 1.9% by 2024. That figure might sound small to an economist, but on the ground it meant billions slashed from essential services. Energy subsidies were cut, forcing families to pay double or triple for gas and electricity. Transportation fares rose. University budgets were frozen. Meanwhile, inflation galloped past 140%, eating away at wages that hadn't kept up in years. The peso collapsed so rapidly that informal dollarization took hold. Ordinary people demanded to be paid in greenbacks, not their own currency. And yet, as these domestic crises unfolded, Argentina was sending hundreds of millions in debt service payments to international creditors. The question wasn't just economic anymore, it was moral. How can a nation feed its people when it is forced to feed its debt first? The IMF itself projected that over 9 million Argentinians would fall into poverty by 2024 under the current program. Unemployment surged, but the official statistics couldn't capture the undercurrent. Skilled workers leaving the country, students dropping out to survive, retirees going back to work to afford medication. Argentina's economic data became a story of human decline. But the logic of the deal was defended in terms of credibility and market confidence. In reality, what was being protected wasn't Argentina's people, but the solvency of its repayment schedule. Credit rating agencies cheered when austerity targets were met, even as soup kitchens multiplied across Buenos Aires. The tragedy was coldly efficient, and this wasn't the first time such precision was applied. In the 1980s, IMF conditionalities across Latin America produced similar outcomes: short-term stabilization in exchange for long-term erosion. Bolivia, Mexico, and Brazil all saw increases in inequality, malnutrition, and political instability as public institutions were hollowed out. Debt became the organizing principle of governance. Budget proposals weren't judged by their vision or impact, but by whether they satisfied external targets. Democratic choices narrowed. Election promises shrank. Finance ministries became the most powerful institutions, not because they served the people, but because they served the creditors. Argentina's case is extreme but instructive. Its 2018 IMF bailout was the largest in history, yet the economy shrank. Inflation soared. Social indicators worsened. But the real warning lies in how the program failed, yet was repeated. The 2023 deal imposed similar targets, based on the same flawed assumptions: that growth would follow cuts, that investor confidence would return if the poor suffered enough, that repayment would be possible if the people just endured a bit more pain. These were fictions, dressed in technical language, but deadly in execution. And the IMF knew it. Their own internal evaluations showed the 2018 deal had been based on over-optimistic projections and political naivety. But instead of rethinking the model, they reapplied it, because in the debt empire, failure is not disqualified. It's part of the cycle. Consider the structure of repayment itself. Argentina owes debt in dollars, but it earns in pesos. Every payment requires either the use of foreign reserves, draining the central bank, or new borrowing from multilateral lenders to pay off old loans. It's a circular system with no exit. In 2023, Nearly 45% of Argentina's export earnings were committed to debt service. That means nearly half of what the country sells to the world goes to past obligations, not future development. Imagine a household forced to sell its furniture each month just to pay the mortgage on a home it no longer owns. That's the sovereign debt trap, and Argentina is not alone in it. From Sri Lanka to Zambia, the same dynamics are playing out. Currency devaluation, capital flight, IMF rescue, social unrest, new elections, new deals. The crisis is portable, the template reusable. What changes is only the name on the agreement. But the consequences are always the same: loss of agency, deepening poverty, and rising resentment toward both local elites and international institutions. And yet the machine continues because it is profitable for those who write the rules. Investment banks, hedge funds, and multilateral agencies all benefit from keeping debtor nations compliant and desperate. Stability isn't the goal. Servicing is. In this context, Argentina is more than a country. It's a cautionary tale. The data points to collapse, but the policies continue. That's not incompetence. That's design. The longer the country stays in the loop of debt, austerity, partial recovery, and relapse, the more predictable, and therefore manageable, it becomes to foreign power. A nation in permanent crisis can be lent to, restructured, advised, and controlled. That is the real function of sovereign debt today. It isn't just to recoup what was lent. It's to lock in a relationship of dependency where the debtor is never truly free, and where selling your future is not a moment of failure, but a requirement of survival. There was a time when Argentina dreamed bigger. In the early 20th century, it was among the 10 richest countries on earth. With vast natural resources, booming agriculture, and a thriving immigrant population, it was called the Land of Silver, not just by name, but by promise. Buenos Aires rivaled European capitals in wealth and architecture. The peso was strong, and the future looked unstoppable. For many Argentinians, their grandparents lived in a country that felt modern, respected, and full of potential. That past still lingers in the nation's cultural memory, not as nostalgia, but as a painful contrast to the present. Because the decline didn't come from war or disaster. It came from choices and from debt. The pivot came mid-century when Argentina began borrowing to fuel industrial growth. The intention was ambitious: import substitution, infrastructure, national development. But the borrowing quickly outpaced capacity. By the 1970s, under military rule and later unstable civilian governments, the debt ballooned. Much of it was odious, used to fund corruption, cover capital flight, or prop up regimes. Still, when democracy returned in the 1980s, the debt remained, now legitimized. That's when the IMF stepped in. What followed was the lost decade, not just for Argentina, but for much of Latin America. Growth vanished. Poverty expanded. Entire generations came of age amid cuts and currency crises. But the real loss was deeper: a collapse in national confidence. What's most devastating is how quickly people began to internalize the cycle. Young professionals started planning their lives around currency volatility. Entrepreneurs avoided taking risks, fearing sudden interest rate spikes. Families learned to convert savings into dollars and hide them under mattresses. A shadow economy flourished not out of greed, but out of necessity. Trust in the peso eroded. Trust in the system evaporated. The result was a country that functioned under constant self-protection, waiting for the next collapse. By the late 1990s, the dream of becoming a stable, middle-income power had been replaced by a harsher reality: survival. The country pegged its currency to the US dollar in a last-ditch effort to control inflation, but it only delayed the inevitable. When the peg broke in 2001, it triggered a national implosion. Banks froze accounts, entire classes were wiped out, and street protests became a weekly ritual. Yet even after defaulting, Argentina couldn't escape the debt system. Negotiations dragged on for over a decade. Vulture funds bought up distressed bonds and sued for repayment. The country was forced to re-enter global markets under humiliating conditions. That's how the old cycle restarted. And through it all, the people endured. They danced in defiance, protested in plazas, painted murals of resistance. They didn't forget what Argentina once was. But the weight of that memory became a burden. It created a painful contrast with the present, where inflation eats away salaries by the week and young Argentinians flee the country in search of stability abroad. The sorrow is generational. Grandparents remember a nation of promise. Parents remember the crisis. Their children only know collapse. And still the debt grows. Nostalgia in Argentina isn't a longing for the past. It's a quiet fury about what was stolen. Not just wealth or status, but possibility. A future that could have been built, had it not been mortgaged away in silence. The tragedy of sovereign debt is that its damage is invisible until it becomes irreversible. Schools don't fall overnight. They decay. Hospitals don't vanish. They wither. National pride doesn't explode. It erodes, piece by piece, year by year, until all that's left is the memory of what might have been, and the recurring question, how did we let this happen again? Something is shifting. After decades of submission to global financial institutions, a growing number of countries are beginning to push back. The debt trap, once accepted as inevitable, is now being questioned and resisted. In Latin America, leaders are speaking openly about the IMF as a tool of economic colonization. In Africa, nations like Zambia and Ghana are demanding fairer restructuring terms. In Asia, Sri Lanka is reassessing the geopolitical costs of its dependency. And across the global south, a quiet rebellion is forming, not with weapons, but with alternatives. One path is de-dollarization. Countries are seeking to escape the tyranny of dollar-denominated debt by trading in local currencies, building regional reserve pools, and reducing exposure to U.S. interest rate shocks. BRICS nations, Brazil, Russia, India, China, and South Africa, have publicly advocated for alternative lending institutions and development banks that don't impose Washington-style austerity. China, through its Belt and Road Initiative, offers billions in infrastructure financing with fewer political strings, though not without its own risks. Still, for many debtor nations, the appeal is clear: sovereignty over conditionality. Another shift is in public awareness. In the past, debt negotiations happened behind closed doors, shielded by jargon and bureaucracy. Now, citizens are demanding transparency. Social movements in Argentina, Lebanon, Kenya, and Pakistan have begun linking debt to justice, asking not only who borrowed, but who benefited. Calls for debt audits, accountability, and even cancellation are no longer fringe demands. They're gaining traction, especially among younger generations who see their futures mortgaged away. Technology, too, is altering the playing field. Blockchain-based finance and decentralized lending platforms, while still experimental, offer a glimpse into a future where access to capital might no longer come exclusively through Western-controlled institutions. It's not a revolution yet, but it's a fracture. And fractures matter. Argentina, despite its deep entanglement, is part of this awakening. In recent years, intellectuals, economists, and civil society leaders have begun framing debt not just as a fiscal issue, but as a form of neocolonialism. The conversation is changing, slowly, painfully, but undeniably. The question is whether this shift will come fast enough to prevent another lost generation, or whether the system, perfected over decades, will absorb dissent and continue as usual. Either way, the illusion of inevitability is fading, and that may be the first real step toward freedom. Debt doesn't arrive with tanks. It arrives with contracts. It doesn't shout. It whispers through interest rates, payment schedules, and technical conditions buried deep in agreements few ever read. But the outcome is the same: control without consent, power without presence. That's the genius of sovereign debt. It masks domination as assistance and surrender as policy. And when a nation accepts the deal, it rarely realizes what it's truly giving up. Argentina is no longer just a country in crisis. It is a symbol, a case study in how modern empires operate without flags. The IMF doesn't need to occupy land. It occupies budgets. It rewrites constitutions not with soldiers, but with spreadsheets. And as long as that power remains unchallenged, the cycle will repeat. Debt, austerity, unrest, bailout, and debt again. A machine that feeds on hope and pays in despair. But this isn't inevitable. Sovereign debt is not a law of nature, it's a structure. And what is built can be dismantled. Nations can renegotiate, resist, refuse. They can audit, expose, and reclaim. The path is not easy. It is costly, uncertain, and slow. But it begins with truth, naming the system for what it is. Because when a country sells its soul for debt, it doesn't lose everything all at once. It loses it piece by piece: schools, pensions, dreams, sovereignty. Until one day a new generation looks around and sees a nation that no longer belongs to itself. That's the cost. Not just the money paid, but the silence accepted. And in that silence, the empire grows stronger. Unless someone finally says, enough.